There are a few in the month that really are keenly watched. I think the most obvious one is US non-farm payrolls. Now, once a month, the US government releases an official statistic for the number of jobs created or lost in that month. And they also release the percentage unemployment figure for the US. Given the importance of the US to the global economy, despite everything, it is still the #1 economy, and much of the rest of the world stands or falls by the performance of the US. And so it is the busiest period in the month for IG. The number of trades processed around the non-farm payrolls report skyrockets. And the market does tend to go quiet in the immediate minutes before the report, as everyone waits to see, is it a good number, is it a bad number? And that leads clearly to sustained volatility, and the market tends to sort of move quite rapidly in the wake of non-farm payrolls as investors try and work out, is this a good number or is this a bad number? And how they view that depends how the market performs for the rest of the day. Now, so it's clearly something to be aware of, I think, but it's also something perhaps not to go too near, really, in terms of trading. A lot of people ask IG, how do we trade the non-farm payrolls? And whilst you can, and it is possible to do that, it's very hard to gauge the immediate reaction from the market, and it can swing higher and then immediately drop lower again. So do be aware that it is one of the most volatile periods in the month, and that unless you're very confident in what you're doing, you may want to sort of watch it from afar and then enter the trade after the noise has died down. Since the crisis, central banks have become very much more important in terms of their outlook and how they view the performance of the global economy. So the meetings by the Fed, the Bank of Japan, the European Central Bank and the Bank of England have become very important, because it's when they issue their expectations for the months ahead, and also whether they're going to boost or reduce the size of their QE programs. It's particularly important in the case of the Fed, because markets have become used to QE from the Fed. It helps keep the market going. It's indeed helped the market to rally since 2009. A lot of people will argue, is this a good thing? But regardless of that, it is an important moment for markets to see how central banks view the economy. In terms of the Eurozone, the ECB is even more important, because we know it sets interest rates, and it boosted interest rates in 2011 and 2012 slightly, and that arguably caused the crisis to sort of reignite again. And so talk of a possible rate cut always attends ECB meetings, see whether they will ease the crisis by that. And also, in the summer of 2012, the ECB was very clear that it would do whatever it had to do to save the euro. And this sort of clear determination gave markets a new boost of confidence. If you have the European Central Bank coming out and saying, whatever happens, we will help support the euro and the eurozone, that certainly makes investors more relaxed about the eurozone crisis. So in central bank decisions, whether they come from the US or from Japan or from Europe, are always ones to watch out for. Yeah, the numbers for GDP around the world, they're issued by the official statistics agencies of the various countries, but these are just posted up on the website and flashed around to markets via the news wires. But these are still key elements. And you get revisions of GDP data as well. So you have the first number, which doesn't include all the data for the most recent 3-month period. And then as more data arrives, they'll issue a revision to that number and another revision after that. But I think it is clearly important, because this is your immediate reaction to how well an economy has performed. In the UK, we know that the government is paying close attention to these figures, and they've been weak of late, and that's used in political discussions, but it's also used by the market to gauge how well they think a particular economy will do. It has improved since the crisis. Certainly we're not looking at quite the dire situation we were, but these data announcements do provide some degree of volatility, especially in the FX area, because that's where you see the most immediate reaction as traders try to gauge what the number means in the future, if it's worse than expected or if it's indeed better than expected. So I think the expectations are almost more important in some ways than the number themselves. Investors always attach great store to economic predictions, whether they be wrong or not. And if the number comes in above expectations, then a sense of relief can be felt. And conversely, if you get a weak number, you see immediate reaction. So if UK GDP is below expectations, you'll see a drop in the pound against the dollar. For example, if the revision comes through, markets may think that's slightly positive, but also start to worry that, well, this data was good, but if we get even more data, how will that play with the market? If more data will contradict the previous reading, then markets are sort of really trying to work out where they stand. And as anything, markets are driven by buyers and sellers, so there'll be plenty of people trying to divine some meaning from the GDP figures. And it's worth bearing in mind that the initial reaction may not be the one that stands by the end of the day.
Cool. And what is the consumer price index? How does that work?
All countries try and work out price movements and see how that's affecting consumer income. And so they usually construct what's called a basket of goods that contain various common items that all people in the country tend to buy. So that's called the consumer price index, and they track the growth or the decline in that index and see how that's affecting inflation. Now, usually if you're having an economy that performs better, that tends to push the prices up. So you see a rise in the consumer price index, and then that leads you to think, well, if inflation continues to increase, you might see the central bank looking to boost interest rates as a means of counteracting that. So it's a constant battle really between spending and saving, and the central bank tries to influence that by using the interest rate, and its main decider is the consumer price index.
And that's, is it once a month?
That's once a month for all economies. You also get the retail price index, which is another different basket which can be used, and also look at home price indexes as well, which so all three together really help to get a broad sense of how the economy is faring.
And during these announcements, are people just literally at their computers with their finger on the keyboard?
There are some certainly who are doing that. FX traders in the city especially will be watching carefully to see how that number plays out. And again, it's all about expectations. Is it worse or better than expected? So the key thing is expectation management. But yes, you will see an immediate reaction in the currency markets. So it's worth bearing in mind when these numbers are coming out. For the UK, for example, they come out about 9:30 in the morning. But it's worth knowing when they come out and what the expectations are, so you can then put that in context and try and understand the move in the market. And obviously, if you're unsure about what the number might come out as, it's worth adjusting your stops accordingly to account for that increased volatility.